All right, in this video, we are going to be ranking all of your favorite stocks from best to worst from the standpoint of a long-term value-oriented investor. So I've got all the big names here, all the names that you guys know and love, and then a few smaller ones that maybe you haven't heard of. So let's get into it here. So first and foremost, we are going to start with the king of the stock market, the stock that is propping up the entire stock market, which is none other than NVIDIA. So NVIDIA, where would I put NVIDIA? That is a great question. So this is arguably the most important company in the entire world at the moment. They sell a product that the whole world wants and needs, which is their chips. And this is the company that is single-handedly responsible for the build-out of AI. Now, as a long-term value investor, I do have some problems with this company because, well, we are undeniably in an AI bubble. Where we are in this bubble, nobody knows, but eventually the bubble will come crashing down. And of course, the leader of the bubble will be obviously in a tough position when that bubble pops. You know, that is undeniable. So if you benefited from the AI bubble, you are going to be hurt when the AI bubble eventually pops. Now, NVIDIA does not have a very bad valuation. The forward P is actually very reasonable. The growth rate is incredibly strong. All of the company's metrics, EPS, free cash flow, margins, the whole works is about as good as it gets with NVIDIA, right? That business could not be performing better right now. But the keyword is right now, right? What does it look like when AI demand begins to fall off, right? They're probably going to be hurt. Now, if you're a long-term investor and you want to hold the stock for, let's say, 5 or 10 years, I would say when the AI bubble pops, if you're buying now at these valuations, you know, you're probably going to be a generational bag holder. But of course, if you happen to be a momentum trader, you know, you can probably still make some money in NVIDIA regardless. But since this is a video about long-term investing, I would have to put NVIDIA in C tier, despite the fact that it is a incredibly important company. Okay, so that's NVIDIA, C tier. I know it's going to upset a lot of you guys, but that's okay. You can come at me in the comments. I don't care. So next up on the list here, how about, let's do Amazon. Okay, so Amazon is another big company, another household name. Everybody has shopped on Amazon at some point or another. Now, the thing I like about Amazon is that they have a massive moat. They have a massive infrastructure moat. They're absolutely dominating when it comes to AWS. Amazon is undeniably a great company and a company that's going to be around for a very, very long time. And even if the stock market were to crash 50% tomorrow, Amazon will eventually come back and do quite well. Now, the only thing about Amazon that I don't like right now is that the valuation is a little bit rich. I believe they're trading at, I believe they're around 35 times earnings, which is a little bit rich. I think the growth rate is around 15%. So it's just, the valuation is just a little bit steeper than I'd want it to be. But Amazon is a great company, and I think it's going to continue to do very well long term. So that for that reason, I can't put it in S tier because the valuation is too high. But I will put it in A tier because the business is as premium as it gets. The mode is as premium as it gets. But just the valuation is holding me back from putting it in S tier. All right, how about, let's do Palantir, okay. Palantir is another stock that is incredibly popular among retail investors. It has a cult-like following. Everybody who likes Palantir says that it is one of the most important companies in the world, that is going to change the world, you know, et cetera, et cetera, et cetera. However, the valuation is ridiculous. It has already gone on a massive tear. It's up like 30x from its bear market lows. It has a forward PE of 500. So as a value investor, you got to stay far, far away from a company like Palantir. I don't care how good the company is. I don't care how much you like Alex Karp and his vision for, you know, the business and the world, whatever it may be. You got to stay far away from a company like Palantir if you want to avoid being a generational bag holder, because at some point the market's going to crash and high flyers like Palantir are going to get destroyed and you will be left holding the bag for a very long time. Now, of course, Palantir has a lot of momentum, and in the short term, it could go up a lot. You know, it could still double from here. Who knows? but you're really chasing momentum at this point in time. So I would say you'd have to avoid Palantir, despite the fact that it's good company. So I put it in D tier. Now, if Palantir was trading at 20 times earnings right now, I would put it in S tier, but that's not the case. This is a value-oriented video. We're not talking about the overall quality of the businesses. We're looking at the quality of the businesses plus the valuations. You got to get both right if you want to make money in the stock market and to avoid being a generational bag holder. Okay, so that's Palantir, so D tier. Yep, sorry, not sorry for that one. Let's take a look at, let's do Tesla. So that is another big name. That's another stock with a cult-like following. Everybody loves Elon. Everybody loves their Tesla cars. Robotaxis are coming. Robots are coming, the whole thing, right? The problem with Tesla is, again, despite the fact that it's a really cool company and has all these amazing innovations, the valuation is still ridiculous. You cannot justify the valuation. Now, again, it could go up from here. Maybe the stock catches some momentum and it doubles, but from a value perspective, you got to stay away from Tesla because the valuation is ridiculous. And if they were to have a bad earnings report, the floor for this stock is so far below the current share price that you could end up in a lot of trouble. So Tesla I would put right next to Palantir here in D tier. That's right, D tier for Tesla, D tier for Palantir. I know, call me crazy, I don't care. Next up, let's see here. Let's do Apple. Apple's an interesting one. Apple was a big Berkshire Hathaway, Warren Buffett stock for a long time. I think he bought back in 2016 when the PE ratio was 10. Well, now the PE ratio is, I think, closer to 40. So Apple has gone up a lot. There's been a valuation expansion for Apple stock. And really, Apple's not very innovative anymore. I mean, the iPhone, you can't even tell one iPhone from another these days. There used to be a time where every new iPhone that got released, it was groundbreaking, it was recognizable, it was distinguishable from other iPhones. But now they completely blend in. Like the other day, somebody asked me what iPhone I had. I didn't even know. I literally forgot what iPhone I had. I had to look into my settings to see what version. So, it's just, the iPhone has kind of become a commodity. Now, the company still has a big moat, and it's a cash cow, and they have the service business, et cetera, but the valuation is very stretched at this point, and there's not a lot of innovation. There's not a lot of top-line growth. So when it comes to Apple, I really don't like it long term. I just think that the market's treating it kind of like a bond in a sense, just a little bit more of a just sort of like a leveraged bond, just something that's a little better than a bond. So I don't really like it. It's not a stock that's going to make you rich. So I'm going to put it in C tier next to NVIDIA. Next up on the list here, let's do Google. Yeah, Google's an interesting one. Google has just gone on a massive run. 6 months ago, everybody thought Google was dead. Everybody thought that Google was going to lose to OpenAI, ChatGPT. They thought that search was going to be disrupted, right? So the moat of Google and search was under question, under scrutiny. However, since then, Google really got it together, and they released some amazing Gemini models. And now the market's starting to think, oh, hey, maybe we got Google wrong. So they bid up the stock price. So the stock price is now up 100% from where it was back during all the tariff drama back in the spring. So Google is a great company. YouTube is phenomenal. You have Waymo coming, their autonomous driving. You've got cloud, which is great, but it has gone up a lot recently. So it's hard to buy. You really don't have an entry in Google stock right now after it's run up 100% in such a short amount of time. But it is an amazing business, and it's going to be around for a very long time. So I put Google in A tier next to Amazon. Now it has the makings of being an S tier stock, just like Amazon, but the valuation is a little bit high right now. So how about let's do MicroStrategy. So the Bitcoin treasury company, Michael Saylor. The thing about MicroStrategy is, in my opinion, I think you would be much better off just buying Bitcoin, right? Why take the third-party risk? It's really not necessary. I know that you can buy Bitcoin for like 80 cents on the dollar right now, or whatever it may be, via purchasing MicroStrategy stock, but I just don't think it's worth the risk. I think if you want to own Bitcoin, just buy Bitcoin outright. So for that reason, I would put MicroStrategy in D tier. I just don't think it's necessary. Just buy Bitcoin. You're going to be better off, and you don't have that blow up risk like you do with MicroStrategy. How about let's see here. How about Alibaba? So if you've been following my channel, you would know that I'm a big bull on Alibaba. I love the company. I think the Chinese economy is going to do great things over the next coming years. I think they're really starting to turn the corner when it comes to their economy. They really took a hit during COVID, and also their large tech companies took a hit from the CCP regulating them around that time. So they took a big hit. All the major stocks in China went down 70%, 80, some even 90%. But they're starting to be resurrected. And the business of Alibaba is doing very well too. So, you know, you have their cloud business, which is going absolutely crazy right now. There's a ton of demand for their AI products. Just a year ago or 2 years ago, there really wasn't any growth at Alibaba, but that has changed rapidly the last year, especially the last 6 months. I mean, cloud went from growing at 5% to now growing 35%, and the growth rate continues to accelerate. Their core e-commerce business, Taobao, Tmall, are also experiencing accelerating growth rates as the consumer begins to wake up in China, because they're beginning to come out of recession, and this is all supported by the CCP doing stimulus, monetary stimulus. So Alibaba is really good. I'm super bullish on it long term. I think it's going much higher. In fact, I would not even be surprised if it trades at $1,000 at some point over the next decade. It has gone up a lot recently, so it's not the deep value play that it was a year ago, but I'm still very bullish on it long term. So I would put it in A tier, right next to Amazon and Google. So continuing on here, what do we have? Let's take a look at Airbnb. So Airbnb is kind of an interesting one. It was a very popular IPO. Airbnb is a household name. Everybody knows it. You probably stayed in Airbnb. The stock really hasn't done much the last few years, generally because the economy hasn't been very good. The consumer has been very price sensitive. There hasn't been a lot of discretionary spending. Inflation has really hurt a lot of people, obviously. So Airbnb just has kind of been in a kind of a weird place from that standpoint. But because the stock has just been trading sideways the last few years, the valuation has come down a lot. And they're also still growing, despite the fact that the general macro is not very favorable at the moment. So I actually really like Airbnb. I think they have a big moat. I think they have the network effect. I think that eventually the consumer is going to wake back up and they're going to start spending money on traveling once again. And when that happens, Airbnb is probably going to do very well. And I really don't mind the valuation right now. I think a lot of the metrics are quite good. Free cash flow, top line growth, bottom line growth, the whole works. Strong moat network effect. So just from a valuation standpoint and then the quality of the business, I would actually put Airbnb in S tier. I'd put it in S tier. So I think it's a solid investment. I think that Airbnb is a stock that you could buy right now, and you're probably going to do okay. Let's see, what else do we have here? We've got, how about Robinhood? That's another popular retail stock. So Robinhood is a stock that has done crazy well the last 12 months. It is up massively. There's been a lot of retail interest in the market once again because of AI, and crypto kind of had a little run there for a while. A lot of people got back into Robinhood. Now it collapsed massively back in 2022 when the market collapsed. Everybody gave up on trading, but now trading's back again, so Robinhood is doing well. I think it's a good product, but I think the valuation is ridiculous. I think it's a momentum trade at this point, so I think you want to stay away from Robinhood from that standpoint. Again, these momentum trades can always go much higher, but this channel is not really about momentum. It is about value. So I will put Robinhood in D tier. I don't like it. How about Adobe stock? This is another one that's gotten pretty popular among retail investors recently because the stock price is down 70%. And anytime a stock goes down 70%, you get a lot of retail interested in it because they think it might be cheap. Well, when it comes to Adobe, I think it's a very interesting business, and I think it's misunderstood by Wall Street. Again, it's much like Google. It's very similar to where Google was 6 months ago, because 6 months ago, The market was worried about AI. They were worried about Google search being displaced. But that did not happen. And right now, the market is now worried about Adobe. They're worried that Adobe might be losing its edge because of AI, right? Because you can go and use, Gemini, Nano Banana, or ChatGPT's image creation function, and you're able to create really cool graphics, etc. So the market's like, well, maybe people will start using AI to create their graphics. But in reality, when it comes to commercial grade deliveries, right? If you are a professional creative and you're working with brands, AI does not give you the level of control that you need to actually deliver a professional grade image to your customers, right? So if you're working with a big brand, you do not have the flexibility and functionality from AI right now to really create a delivery that is commercial grade. And if you are a creative, let's keep in mind that if you use Adobe's products, you've spent years and years learning how to use them. They're very complicated software, right? The software offerings of Adobe are extremely complicated and difficult to use, and people who have learned them, they've spent years learning how to use them. They're very, very powerful tools, and the degree in which they are powerful exceeds AI massively right now. It's not even comparable. With AI, you just do not have the flexibility and nuance that you need to actually deliver premium grade deliveries for your clients. So for that reason, I think Adobe's moat is much bigger than the market understands. And also the valuation is very, very low right now. And even despite all of the AI fears, Adobe is posting record revenue growth, record profit. Adobe has not seen any sort of decline as a result of AI, right? They're just plowing through business as usual, but the market has sort of faded the stock because of fear. And because of that, I think Adobe is actually a pretty good opportunity. And I think that it's, as I said, I think it's misunderstood. So just from a value-oriented perspective, from a moat perspective, I would actually put Adobe in S tier for a value investment. I think it's very good. Another one that's kind of a deep value right now is PayPal. PayPal's gotten really popular among the retail crowd right now because, again, the stock price is down, 70% from its all-time highs. And PayPal's kind of interesting because the valuation is very low. It's trading at 10 times earnings, and it's growing EPS at around 14%. So that's a pretty rare occurrence. Usually you don't see that low of a PE with that strong of EPS growth. So it's got a lot of value investors very intrigued by the stock. Now, of course, the problem with PayPal is that they are losing market share to other payment processors like there's Shop Pay, there's Stripe, et cetera, et cetera. The list goes on. There's a lot of saturation in that niche. But despite that, PayPal is still able to grow. And if they continue to do so, the stock is definitely cheap. Now, I don't think it's a 5-year hold or a 10-year hold, but I could see PayPal doubling or maybe even tripling in a relatively short amount of time. But I do think that the overall trend is against them, but I think that the valuation is definitely too cheap to ignore. So from that standpoint, I would actually put PayPal I'd probably put it in between B and A tier. But I'm going to put it in B tier because it's just not at the quality of Amazon and Google. But I'm putting it in a B tier because the valuation is very intriguing. And also, the company is doing a lot of buybacks, which puts a nice floor on the stock price. So I really think that PayPal has probably already bottomed or very close to bottoming. But I don't think it's a multi-decade compounder. I just think that it's a valuation play. And if you want a decent gain over a year or two, PayPal might offer it. Going on to let's do Meta here. So Meta, Facebook, everybody knows this company. I really like Meta as a company because they are the kings of advertising, right? Their advertising platform is unmatched. If you are a small or medium-sized business, or even a large business for that matter, Meta is a place to go for growing your brand through advertising, and they are a cash cow. And just recently, Mark Zuckerberg decided to divest a little bit from the metaverse sort of business, right? So they're focusing more on their core assets now, which is very good. So there's a lot of cost-saving synergies because of that. I think the valuation is pretty low right now. The stock has come down recently. The PE really isn't that bad. It's in the low 20s. The growth rate is still strong. I get that Facebook doesn't have a lot of growth, Instagram doesn't have a lot of growth, but ad spend continues to go up on these platforms. So it's not so much about user growth, it's about how much businesses are spending on their platform, which continue to increase because there's a ton of value there. So I really like Meta from that standpoint. I would put Meta in A tier. I can't put it in S tier because it would have been S tier a couple years ago when the stock price was down 80%, right? I don't know if you remember that, but Meta did crash 80% when the Fed started raising interest rates. They had a few issues with the business as well. It was trading at 10 times earnings. When Meta was trading at 10 times earnings, that would have been S tier, but the valuation has come up now, so I put it in A tier. How about Coinbase? How about Coinbase here? So this is another crypto play. So if you're bullish on crypto, there really aren't a lot of avenues to get exposure when it comes to traditional finance, right? So if you don't want to actually go on the blockchain and buy crypto yourself, Coinbase is a good way to get that broad exposure. Coinbase is an interesting business. There's a lot of layers to Coinbase. It's not just a place to buy and sell crypto. They have other businesses, especially when it comes to their layer one, the base protocol. There's a lot of growth there, and the valuation isn't that bad. And I think that we're going to see a big crypto bull market at some point, and Coinbase will be a direct beneficiary of that. Now, their valuation is not super cheap right now, but I could see it as almost like an emerging momentum play. It's not a momentum play yet, but I think it's something that could get hyped. So I think it's decent. I think it's a decent play, but not great. I'd probably put it in B tier. I'd put it in B tier. How about Uber? Uber's another interesting one. So Uber is a pretty popular stock. A lot of people like it. I have some reservations about Uber because you do have a lot of competition coming with, of course, Tesla robotaxis and Google's Waymo. So I really don't know what Uber looks like in a world where we have a ton of autonomous vehicles. I'm not sure how they're going to make that pivot. I think the days of hailing an Uber and having some random person you don't know just pull up and pick you up, they're probably more behind us than in the future. I think that ride sharing will be fully autonomous at some point in the future, and I really don't know how Uber is going to be able to navigate that without some serious issues. So I'm actually kind of bearish on Uber. I know Uber Eats is a pretty good business right now, but I would probably put Uber in C tier. Now, it is possible that they get it together, and the valuation really isn't that terrible right now. So I won't put it in D tier, but I'll put it in C tier. How about Novo Nordisk? So this is an interesting company. Novo Nordisk, they are the producers of Ozempic, which is the GLP-1 weight loss drug. Now, the weight loss industry has been obviously disrupted by GLP-1s, and they are the creator of the GLP-1. And their stock is down about 70% right now from its all-time highs. And the reason for that is because of new competition from Eli Lilly. Their drug got approved by the FDA, and they really started aggressively entering the US market, taking market share away from Novo Nordisk. Now, back when Novo Nordisk had 100% market share in the space, the stock was a high flyer. It was trading at a very high valuation. I think it was trading around 50 or 60 times earnings. And then the stock price essentially got a reality check once the competition started to emerge. So the stock is down 70% now. And I think it creates an interesting value opportunity, because if you are bullish on these weight loss drugs, these GLP-1s, Novo Nordisk still has a very strong position in the market. They have lost market share, but they still have, I believe, 52% market share. And I think right now the valuation is around 13 times earnings, which is very intriguing, especially because they still have their insulin business, right? They are the legacy provider of insulin across the globe, and they have been for several decades now. So even without the GLP-1s, you still have the very successful, very profitable insulin business. So that kind of creates a floor for the stock price. And I think that if their market share stabilizes kind of around 50%, I think Novo Nordisk is set up for a very nice rally going forward. And then on top of that, they have their Wegovy drug, which is about to be approved for an oral form, which will open up the market even more because it's a more convenient way of taking a weight loss drug as opposed to going into your doctor and getting injections, right? So an oral version is going to be very good for the company. And then if you just look at the broad obesity market, right now it only has about 2 or 3% penetration. So if you just take the number of people who are obese, just in the United States, relative to how many people have pursued a weight loss management treatment like Ozempic or Wegovy, right now the market's only 2 or 3% penetrated. So there's a lot of growth that hasn't been unlocked yet. And I think as time goes on, as the drug becomes more available, as more awareness is raised for the drug, they're going to continue to do very well. And I just don't see why you would want to be bearish on these weight loss management drugs, considering how effective they are. There's just so many people who are just never going to go to the gym and work out. There's so many people who are never going to diet. They don't have sort of the ability or discipline to do so. So just being able to pop a pill and lose weight and get healthy, I don't see how you can be bearish on that. So from a value perspective, I really like Novo Nordisk, and I actually am a shareholder of this company. So of course I'm going to put it in S tier because I am biased. So there you go. Going on, another sort of healthcare niche stock, which is United Healthcare. Now this one was badly beaten down because of a bad earnings report. I think the stock went down like 35% in one day, a quarter or two ago. And the reason for that is because healthcare costs are out of control, because they didn't get the price of the premiums right. So there was a bit of a misstep in management from that standpoint. So stock went down, and it's very cheap now. I think it's trading at under 10 times earnings on a forward basis. So it's got a lot of value investors interested in it. However, the issue with United Healthcare is that it's a very complex business. It's a very complex business with a lot of nuance, and you really have to be a professional analyst to understand the business. And for me, I just don't have enough of an understanding in the healthcare insurance sort of business for me to really feel informed enough to buy it. Now, I think that it is a decent play from a valuation standpoint, and I could see it getting back up to where it was before this crash if management is able to get costs under control. So I think it's interesting. I think it's definitely one that if you have the knowledge, is probably worth analyzing yourself. So for that reason, I'm going to put it in B tier. I think it's too difficult to understand, but the valuation is very intriguing, so I'll put it in B tier. Next up is AMD. So AMD is an interesting company. It's kind of positioned, or they've kind of become the little brother trade to NVIDIA, right? A lot of people are bullish on inference. A lot of people are like looking for that company that's going to sort of challenge NVIDIA in terms of chips and compute, etc. So a lot of people are banking on AMD right now to maybe begin to challenge NVIDIA, right? Because so far NVIDIA has been the overall dominant leader in the market, completely unmatched. So the market's just kind of ripe for another company to come along and offer a competing product. And a lot of retail investors are banking on NVIDIA being able to deliver on that. But again, it is a chip stock, so it is cyclical. And if the AI bubble pops, or not even if, but when, AMD is going to be in a lot of trouble, just like NVIDIA and some of these other names, Palantir as well. So, it's a cyclical. I don't think it's a value play. Could it go up a lot from here? Yes, but I don't really like cyclicals. AI bubble is going to burst at some point. So, I'd put it in C tier. I mean, the valuation isn't horrible. The growth rate is strong, but it's just really not a decade-long compounder like Amazon or Google or Alibaba or some of these other names are. So, I'll put it in C tier. Going down the list, we've got Hims. Hims is the popular sort of consumer healthcare stock where they basically offer generic drugs online. So you can go to Hims and an online doctor will write you up a prescription for various drugs, right? So if you're depressed, you can go to Hims and get a prescription for an antidepressant. So they just make it very easy to get prescriptions for a lot of popular drugs. Now the problem with Hims is that they don't have a moat, right? They're just selling these sort of generic versions of these drugs, and they're putting their own branding on them. So there isn't really a lot of a moat there. It's mostly just marketing. They're very good at marketing, which is why they've kind of positioned themselves as a number one leader within the space. But there really isn't a moat. It's all just marketing. And for that reason, I really don't like Hims that much. I'd like to see a bigger moat. And there's also a lot of ethical concerns about the company, right? So, just this idea of going to an online company like Hims and getting a prescription for pretty serious drugs is a little bit concerning, because there's this idea that they might be over prescribing people, right? They might be over prescribing people a lot of drugs that do have very serious side effects, and they tend to be yes men in that regard, right? Very few prescriptions are denied, so a lot of people are getting overprescribed these very serious treatments, especially when it comes to like depression, for example. So I don't really like Hims from that standpoint. I think it's pretty risky because they don't have a moat. So I would put it in D tier. I don't see the vision there. I know a lot of people are really bullish on it, but I do not see the vision. Last but not least, we have Snowflake, which is another very disruptive insurance company. It was Berkshire Hathaway backed early in the day, so a lot of people kind of discovered it from that standpoint. But again, it's another insurance company, which are of course very hard to analyze. There's just so much nuance, so many moving parts. The margins are very low. It is very disruptive, which is good, but the stock price has gone up a lot recently. It is up massively from its bear market lows that occurred after the Fed started hiking interest rates in 2022. So it has gone on a massive run, and at this point, even though it's very disruptive and innovative, I think it's more of a momentum name. So from that standpoint, I don't like it that much. I think that it's probably going to go on to do good things long term. So I won't put it in D tier, but I will put it in C tier. All right, so that is my take on 20 of these popular stocks, especially by retail. So if you like the video, like, comment, and subscribe. Alrighty, guys, thank you.